Hello and welcome to Climate Bond Initiative's 2016 webinar series. Today, we're exploring green bond labels and standards with Anna Creed, who's the standards manager here, and Justine Lee-Bell, who's senior manager here at Climate Bond. But first, a couple of housekeeping codes. To keep up to date with our work at Climate Bonds and for announcements of future webinars series, you can register our Climate Bonds on there. If you have any questions as we go through the presentation, in the box in the bottom right corner, I'll put them in the. Finally, the will be recorded and sent by email to all those who have registered. Now over to Anna.
Thanks, Johnny, and good morning and good afternoon, everybody. And like Johnny said, we're going to be talking about green bond labels and standards this afternoon. And we're going to start that with a recap of what CBI does and an overview of the green bond market, just for those of you who are new to this field. That's just a very quick overview. And then we're going to move on to the attraction of green bonds and the importance of credibility of those green bonds. Before moving on then to the green bond labelling space and the different types of labels and the role of standards. And finally then we're going to do a deep dive into the climate bond standard itself. Okay, so first off, a recap of green bonds. A bond is essentially just a form of debt. So there is a loan taken out, a borrower and a lender. Interest is paid on that debt and it's repaid at maturity. Bonds are usually large size and they generally issued by large entities and used to finance large mature assets. They are issued by a wide variety of organisations, including companies, governments, municipalities and banks. And those organisations actually often buy each other's bonds as well. So lending to each other essentially. An important part of the investment portfolios for investors, such as pension funds and insurance companies, and in this sense they're often a defensive investment because they can secure money into the long-term future. It's been said that people go into the equity markets to make money and they go into the bond markets to keep their money, which is quite a useful way of remembering that. And specifically, a green bond is a bond where the proceeds are used to finance environmentally friendly impacts and assets. And this in itself has an impact on who wants to buy green bonds and the activity that we're currently seeing in the market. And obviously, climate itself is a huge challenge and an opportunity. And it's been costed that between 50 and 90 trillion dollars are needed to finance low carbon transition over the next 5 years. Okay, and one thing that's interesting to note, so when we're talking from a climate frame, we're often talking about mitigation and adaptation and resilience. In the investment community, we're talking about asset classes. And really that then comes together, and the cross between those two is we can talk about renewable energy assets that are obviously delivering mitigation benefits, such as solar, wind, bioenergy, geothermal investments, hydropower, marine, such as wave and tidal facilities, for example. And then moving through other sectors of low carbon economies and development plans, we have low carbon buildings and industrial facilities with high energy efficiency, for example. We have low emission transport, including rail, electric vehicles, bus rapid transit, for example. We have water assets for water infrastructure and delivery of clean and wastewater. And storm adaptation and water collection assets. We have waste and pollution management, including methane reduction facilities, for example. And then we have the land use space, where we have agriculture, forestry, mining to some extent, and the impact that they have on the land, and the mitigation, adaptation, resilient impacts of those assets in the landscape. And finally, without an icon, we also have things like information communication and technology, broadband issues, which can also have mitigation impacts. Okay. Sorry, I'm just trying to pull up the next slide. Okay. Green bonds are essentially a growth market. So the first green bond was issued in 2007 by the European Investment Bank. And for those first few years, including sort of 2012 and 2013, it was very much a market driven by the development banks. In 2014, corporations got much more involved, and there was a jump up in the level of green bonds being issued in the market, and that steady growth continued into 2015. And as you can see on this bar chart, we are anticipating dramatic growth this year in 2016, with a target of, we anticipate, $100 trillion of green bonds being issued this year. Already we're up to $18 billion of green bonds being issued, and a large chunk of the 100 billion is expected to come from China alone. 46 billion is anticipated for China alone in 2016. And when China issues bonds, they tend to be quite large, so that's a big contributory factor, that geography's impact on those numbers.
Sorry, Anna, can I just jump in really quickly? And hi, everyone. This is Justine from Client Bonds Initiative. Just to recap on the last two slides, I think particularly as Anna was running through all the different areas of the global economy that we have opportunities in, is quite significant. What we should be looking at is every major sector of the global economy has got an opportunity for investment, and there's a number of different key investment areas within each sector that was going to bring those to a low carbon and climate resilient economy. Massive infrastructure needs globally. There's not a country that is not untouched by this need to address climate change from both mitigation and adaptation potential. And in terms of the growth of the market, green bonds is serving to be that one instrument that can help us with that rapid transition. And the entrance of having China and India in particular coming to play ball in this market in the last few months, in particular China, as Anna has highlighted, sitting now roughly hovering under about 50 billion of US dollars of issuance signed off by the PBOC alone for their domestic market, is loud and clear to see that this is not just a market that is segregated to just the U.S. or the European market. Although there continues to be incredible opportunity out of those, it's what the emerging markets can offer, which is going to be really exciting.
Great, thanks, Justine. Thank you. And so just having a quick look at the range of green assets that have been included in green bonds in 2015, these numbers are from. We see that a large portion is relating to renewable energy, and we see a lot of wind and solar bonds. And there's a large chunk here for energy efficiency, a lot of which are around low carbon buildings, commercial buildings and residential and other. And we also see an increasing growth in low carbon transport. So like I said, things like rail systems, electric vehicles, hybrid vehicles, bus rapid transit, things like that. And water is a growing sector, definitely. There's a lot of public entities and municipalities with large water infrastructure assets that are increasingly going to market with green bonds. And finally, slightly smaller segments at the moment, but things like agriculture and forestry, I think we should see those increase. They're growing quite rapidly, still quite small, but we should see those increase as we get greater clarity in the market about what counts as green investments in those areas. So very much a space to watch at that end of the circle. Okay. And then just a very quick overview of the Climate Bonds Initiative itself and what we do. We have 4 main working areas. The first one is the Climate Bond Standard and Certification Scheme, which we convene experts to come up with definitions for what's a green investment, and also insurance processes through certification. And that's what we're going to talk a lot more about in the rest of this presentation and webinar. And the second item is we provide a lot of data and information flows for rating agencies and index providers. Obviously, developing this market, one key aspect to that is going to be ensuring a robust and comprehensive and extensive data set. And so we do a lot of work in that area. And that little icon there is for our State of the Markets report. And just to flag that our next version of the State of the Market report is due out on the 1st of July, which will recap on the previous year's green bond issuances as a really helpful summary of that space. And again, we'll talk a little bit more about those information flows later in this presentation. The third area is we do a lot of outreach to inform and stimulate the market, and that's with governments. We look at a lot of policy models. We do a lot of effort in emerging markets to grow issuance, and that's kind of twofold. One is that we aiming for penetration in those markets to assist with alignment between domestic regulation and cross-territory standards. So we're doing quite a lot of work in that space. And we're also seeing increasing issuances in those emerging markets as well and supporting that. And we lastly have our Partners Program, which is for those who want to get deeper into this space, and we're always open to hear from you in that respect if you are interested in participating further in the Climate Bonds Initiative work. Okay, and the next section is the attraction of the green bonds and the importance of credibility. And questions that we're often asked include, why is green good, and what is the value of green and green bonds to an investor and to an issuer of the bond, particularly sometimes when there are additional costs to deliver a green bond. And it's worth sort of thinking about this in the 2 parts. One side is the lender or the investor, and the other side is the borrower or the issuer. And from the borrower's point of view, what we're seeing in the market at the moment is issuing a green bond often brings in a diversification in investors across different types of investors and different regions that they're coming from. And we also see greater investor engagement and stickiness. And by that I mean those investors tend likely to buy and hold the bond and might come back and rebuy for a second tranche as well. And we also see what we're seeing at the moment is very strong demand. Demand is exceeding supply, so there's often oversubscription, sometimes as much as 5 or 6 times over, and tighter yields coming off the back of that. And then more generally, for issuers, there are obviously strength and reputational impacts if it is a credible green bond, and the ability to align their CSR with the kind of green bond objectives, essentially, and the climate mitigation and adaptation objectives. From the lender point of view, one key thing is that it's basically well understood projects will reduce risk exposure. And by that we mean what's critical in the bond space is, the green bond space, is that we understand the use of proceeds and we understand whether or not those proceeds are financing green assets and green investments. And so this level of attention to what is green and what isn't is important in identifying, for example, stranded assets. So if you have a water asset, if you're looking at that water asset with a climate lens, you might be thinking about things like, is this water asset going to last for its operational lifetime, which might be 50, 60, 70 years? Is it set up to deal with the changing climate? Will it still be operational and revenue generating over its lifetime in a changing climate, and the impact that that has on the functioning of the water asset? So basically that awareness can lead to a reduction in risk exposure because it leads to changes in management practices. What's sometimes said is what's being measured is going to be managed, and I think that's probably quite a good principle to bear in mind with the green bonds. And there's also some evidence that green bonds are trading at a premium in secondary markets as well. And again, like with the issuer, investors get benefits like a strengthened reputation and deeper engagement and alignment across green and CSR objectives on that one. And then what is really critical when we're talking about green bonds is that those bonds, the greenness of those bonds is actually credible. If issuers are claiming benefits from the green aspects of the bond, they really need to protect investors from greenwashing. And by greenwashing, I mean that the projects have been subject to some kind of makeover so as to seem like they have environmental benefits, but really they don't. And as there's explosion in the bond market, it's more difficult for investors to evaluate basically the greenness of individual bonds if there's inconsistency in the way that's being evaluated or reported. So essentially, as we've said here, what we need is a system of environmental due diligence to complement the existing financial due diligence. And basically, investors, it's very difficult for them to do this themselves, partly because specialist expertise is needed, scientific understanding of what counts as green, what's really going to have a positive climate impact in the short term and over the long term. And also, it's very costly for them to assess and verify that themselves. Doing a deep dive on each individual bond by each potential investor would be individually and collectively a time-consuming and expensive exercise. So if we're trying to establish a good system of environmental due diligence that many people can participate in, the three kind of key criteria that we might want to talk about are that that system is scientifically robust, so that we can stand behind the investments and be sure that they're having a positive climate impact and very certainly not a negative climate impact. Secondary important factor is that the system is transparent so that investors and other interested parties can easily see it's got good, clear reporting. They know what is in the bond and how it's being treated and what impacts it's going to have. And the last thing here, but definitely not least, is that there's consistency. So investors don't need to look twice or in detail each time with each bond that they're considering investing in. Okay, and moving on to understanding green bond labelling. This diagram here is essentially the smaller circle of the green bonds currently outstanding in the market, $100 billion worth of green bonds outstanding. And that in itself is slightly dwarfed by the $600 billion of climate-themed bonds that are out there, but they're not labelled as green. And these include bonds that are issued by what we call pure play companies operating in this space, and just generally bonds that in the market that are delivering climate positive impacts but just haven't been labelled as such. And what we would really like to see is that all green bonds are labelled in that way. This will help us to get to scale and raise awareness, but it will also increase diversity, experience and development of stronger and stronger practices and consistency in the market. And ideally, what we would like to see is a target of $1 trillion per year in green bond issuances in the short to medium term. Basically, when we think about green bond labelling, it's kind of useful to think about three key dimensions here. The first one is reach, and on that we can talk about what sort of programmatic approach is being taken. So, for example, does the label require voluntary or mandatory participation? Is it really a set of recommended guidelines or principles, or is it firmer with a set of fixed standards and requirements? The second dimension is scope, and there's generally three aspects to this. One being the process of management of the funds, the second being the reporting requirements around the bond and the use of funds, and the third being what counts as green. And this is really key to ensure that we're identifying the right assets in a green bond. And here you often hear talk of things like taxonomies or green definitions or eligibility criteria for people to kind of define what is and what isn't green, what will and won't be counted as green. And the third dimension here is the assurance process. And this is really to ensure that investors have confidence in the green bond. And two things are critical here. One is transparency, and the other is who is doing the reviewing and the assessment of the bond. And there's three sort of different types of assessors here. One is a first party, and that's effectively a self-review by the person issuing the bond. The second is a second party, which is essentially a second opinion. And the last one is third party, which is a clear and objective set of criteria with an independent third party verifier measuring the bond against those criteria. And then just a brief history in the evolution of green bond labelling. We have seen a variety of approaches to green bond labelling being used so far. The first activity was a green bond issued, as I mentioned earlier, in 2007 from the European Investment Bank. Basically, they identified the assets that they believed would be consistent with a low carbon future, and they self-reported against performance with that bond. And that was followed very shortly afterwards, also in 2007, by a bond from the World Bank, and that had a second opinion from Cicero against it. And as we saw from the bar chart earlier, 2014 was a turning point with the first corporate green bonds being issued, and these often utilised the new green bond principles and were subject to a second opinion. These green bond principles were developed by the ICMA, or the International Capital Market Association, and they're essentially, they focus on the process regarding the management and reporting of use of proceeds and evaluation procedures, rather than giving a strict definition of greenness. So they are recommendations and principles for green bond issuers to follow. And they really emphasize the importance of the assurance credentials and annual reporting within that. And it's quite interesting to see basically the first activity where the development banks were issuing bonds and self-reporting against them. I think it works well for the development banks because they generally have strong internal systems and structures which can give investors confidence, as we really see a proliferation in the market of green bond issuers from different sizes, different types of organisations, different levels of experience in internal structures and processes. The need for kind of consistency and transparency and external review over that is ever more critical. And as part of that evolutionary process, during 2005, the climate bond standard was enhanced. The climate bond standard very much builds on the green bond principles, but takes it further to define a climate compatible taxonomy of eligible investments and criteria, subject to which a bond can officially be certified under the climate bond standard and certification scheme. And the standard basically has standard and mandatory reporting requirements, which cover the proceeds tracking and reporting. It has specific eligibility criteria for projects and assets, and it has a clear and objective assurance framework that requires independent verification of the use of proceeds under the bond. And I think one of the additional really important developments in this space is countries developing national green bond regulations. And as we've already touched on, a key example here is China, who have issued substantial regulations which are mandatory in the Chinese market, and they also provide a catalogue or a set of definitions of what is green and what are green assets eligible to be included under a green bond issued in China. Okay, and looking forward, investors talk to us over and over again about the need for standards and assurance and certification. And it's really with those kind of things in mind that we can kind of guarantee that the strength and the growth of the green bond market that can only really increase with the delivery of credible and quality products into the market. And there is a risk that if those standards and assessment processes and verifications are not used, then green bond labelling might lose its impact in the market. And really, if we're going to tap into mainstream capital markets, I think a degree of standardization or an enhancement of standardization of approaches is going to be really critical to kind of minimize the time and the the expertise required from issuers and investors to evaluate what's green, because it's probably less likely that mainstream investors will be prepared to put in that kind of effort at the present time. And obviously, as we said earlier, governments have a key role to play in developing and rolling out mandatory green bond regulations, as well as encouraging market development in their national jurisdictions. And critical to success, given this mix of approaches at the moment, is increasing harmonisation of cross-territory standards with national regulations. And in that, so our market development work is quite key. So we do try and work closely with countries and governments that are developing and releasing regulations for national participants to ensure that we are harmonised as much as possible, with subject to kind of national variations according to national priorities. Okay, and just to add here, a really important additional factor to green bond labelling is the additional green signals that we're seeing from the market. So these include the 4 green bond indices that are essentially these institutions using their own methodologies to determine an index score for green bonds. And it's quite important to note that CBI provides the green bond data for 3 of these. And like I said earlier, the robustness and the extensiveness and the availability of this kind of data is really key to all of these activities. And the second additional green signal that's important here is the development of stock exchange green bond lists. So we're seeing this starting in Europe with Oslo, Stockholm, Luxembourg and London already launching their green bond lists. Their stock exchanges have launched those green bond lists, and Mexico and Shanghai have announced that they will launch similar lists. And these don't generally set criteria for inclusion or ranking, but they will list bond as publicly available independent review. And then lastly, we see assessments from rating agencies, and one very useful example here is Moody's Green Bond Assessment Framework, which might be particularly useful in the US. Okay, and then just finally, in terms of the slides, I'm just going to talk more through the features of the climate bond standard, where we've done a lot of work over the previous years, and we will continue to do a lot of work with a wide variety of external stakeholders to further develop and enhance the standard and roll it out into more and more territories and see greater and greater volumes of bond issuances using the standard. And basically the certification scheme has kind of these 3 elements to it, which is clear and objective sector-specific eligibility criteria for projects and assets, clear mandatory requirements regarding the use of the proceeds, tracking and reporting, and also certification by an independent climate bond standards board who represent up to 34 trillion of assets under management, so people with real experience in the green bond market space. The green bond principles are fully integrated into the climate bond standard. Essentially what the standard does is convert the principles into a set of requirements and actions which can be assessed and assured and certified in a robust and repeatable way and a comparable way across bonds. A wide variety of bond types are eligible for certification, and the standard has specific requirements for each of these bond types to address particular risks which might be apparent for that structure. And it's also just finally important to note that the climate bond standard is an environmental standard. It's not a financial standard. So we're always very clear that investors must do their own credit analysis, and the environmental due diligence that the climate bond standard gives is an addition to that, not a replacement for that. And in practice, as we've seen, the standard provides clear requirements for users and their bonds in order for them to be labelled as certified climate bonds. The process aligns with the normal phases of the bond market, so it recognises the pre-issuance phase and the post-issuance phase. So pre-issuance including the getting ready, creating the product, going to market and investors. And I'll talk a little bit more in a couple of slides' time about the actual steps and requirements in each of those phases. And we basically have 3 parts to it. One is the general requirements for a climate bond, and specific requirements for different bond structures. Those kind of parts to it are in what we call the parent standard, and that's common regardless of what you're investing in or how you're using your proceeds. And the third part is the climate bonds taxonomy and sector-specific standards, and that's really where we define what is green, and therefore the bond issuer will use different parts of those sector criteria depending on the actual nature of the assets and the use of proceeds under the bond. And obviously key to this is a certification process so that bonds that have been issued can be labelled as such and have a signal as such in the marketplace. And just very quickly, our governance structure. So I've mentioned the Climate Bond Standards Board, and they oversee all of our activities. They approve the criteria. They are instrumental in approving the verifiers and the actual bonds when they come up to be applied for certification as well. We have a climate science reference group, and the reason for that is we try and paint a picture of the low carbon future, and out of that we have, based on that scientific advice, come up with a taxonomy of potentially eligible assets as a kind of initial screening device to see what will be eligible and what not, subject to the specific criteria that are coming out of each sector. And to develop those specific technical criteria, we have a number of technical working groups, one for each sector, and we basically just convene those groups. They're made up of academics and scientists and NGOs and other experts in the field in each of those sectors, and they essentially draft the criteria based on their scientific and technical understanding of those assets and their impact, and their climate impacts, positive and negative. And in parallel, we convene industry working groups, which are made up of investors and issuers and corporates who are active in that sector. And the reason for doing that is, well, the technical working group comes up with the kind of robust, credible recommendations. It's then tested off the industry working group so that we can ensure that the recommendations that are coming out are practical in the market, that they can be applied, the transaction costs are reasonable and manageable, and they are actually going to have traction in the market. So we try and balance those two things by having those two working groups for each sector. And then we have the secretariat underneath them, which performs, like I say, various convening roles. We raise funding, et cetera, et cetera.
Anna, let me just add, can you go back to that slide quickly, because I'd like to make a few points there. So just for everybody's understanding, I think one of the most important points to make here is that it is actually not Climate Bonds Initiative that is deciding green or defining green. This very much relies on the expertise of our technical working groups from around the world. We look to leverage the knowledge base from China, from other parts of Asia, into Africa, into South America, globally, to represent issues that are facing those regions relative to climate and making sure that we are capturing that in the development of the work. So within each of the major sectors where we have technical committees, that expertise is feeding into the development of the work so that we are capturing the latest scientific evidence that we have. And so we heavily rely on the expert committees that can be anywhere from 20 to 25 folks within a group, which is led by a lead specialist. And then, of course, the climate science framework, which is currently under development, which is underpinning the taxonomy. It is making very clear inclusions and exclusions based on the latest scientific evidence that we have, and it allows us to get a better understanding of where we should be spending time on developing standards, and, of course, addressing areas that we don't really know what we are going to do about. What are we going to do about gas? What are we going to do about nuclear, carbon capture and storage, so on and so forth. And so, and then central to this is very much the Climate Bond Standard Board. This is 34 trillion of assets under management. This is the institutional investor base that is represented on our board, along with NGOs like CDP and NRDC, Mutual Insurance Fund Corporation, and California State Treasury for that matter. So they are integral to providing the support against the standards work on what they approve and what they feel confident in backing, signals to the market the trust with it behind the label, behind the climate bond kite mark. So I think it's very important to just sort of lay out this is a multi-stakeholder approach to standard development with at least 80+ organizations behind it. Thank you, Anna.
Great, thanks, Justine. And just on the next slide, we just have a little bit of an overview about the sectors that we have already have criteria for, those that are under development and ready soon, and other priority areas that are launching very shortly. So we already have criteria for wind and solar assets, for low carbon buildings, for bus rapid transit and other aspects of low carbon transport, and for geothermal energy installations. And it's possibly important to say that they include both those facilities and also the manufacturing of components for those facilities as well. So we do go a little bit down the supply chain on that. We also are developing and will have ready soon criteria that cover various aspects of land use, including agriculture and forestry, that cover water infrastructure, hydropower and bioenergy. And other priority areas for us that are launching soon include waste and pollution, industrial energy efficiency, information technology and communication, energy storage and capture, various marine-focused sectors, including marine infrastructure, marine energy, and waterborne transport, which includes shipping and ports, and other aspects of waterborne transport. So it's an exciting time, and for us this is a critical component of development of the standard and really a large take-up of the standard, getting the criteria to the market basically so that they can use them to evaluate and certify their green bonds as soon as possible. Okay, there's some detail on the next slide about the actual certification process. And as I mentioned before, this comes in sort of two parts. The first part is pre-issuance, and the second part is post-issuance. And the climate bond standard allows certification of a bond prior to its issuance, which means that the issuer can then use the certification mark in its marketing efforts, investor roadshows and engagement. And in that pre-issuance evaluation process, we focus very much on the selection of eligible assets and projects, and the readiness of the issuer's internal processes to track and report on the use of proceeds. And as part of this process, the issuer must engage a verifier to provide assurance over these features, and this information is submitted for review for the Climate Bond Standard Board for their approval. And then post-issuance, there's a further process to understand actually how the money has flowed, what impact it's had, has it been used in accordance with how it was thought it was going to be used, et cetera, et cetera. And so there's a kind of an assurance process that goes on here. And like I say, this includes the actual use of proceeds, the ongoing eligibility of the projects and assets, information about funds not yet allocated. And again, this has to be done by the engaged verifier to provide that external assurance and verification over this information and the process behind it. And these post-issuance requirements, this must happen within 12 months of the bond issuance. And then following that as well, it doesn't quite end there. There is therefore annual reporting, or at least annual reporting thereafter, basically. And some bond issuers are reporting more frequently than that, but we require at least annual reporting after that to ensure that there is ongoing eligibility and use of funds as was stated up front in the pre-issuance process. And that reporting needs to go on both to the Climate Bond Standard Board and also to the bond holders as well. Okay, the next slide just shows a small graphic showing the actual kind of actual steps in this process. So pre-issuance, we have the issuer preparing for certification. They'll provide a draft of the information form to the Climate Bonds Initiative, including the things that I've mentioned, expected eligibility of assets, expected use of proceeds, et cetera, and the verifier will undertake an assessment of that, and that information is submitted to the CBI for the review and the hopefully confirmation of the Climate Bond Standard Board. And then after issuance, so post-issuance certification, the issuer will close the book, issue the bond. The process will be allocated to the projects and assets, and then the verifier will undertake their assurance processes, and the issuer must submit that information and the verifier report to the Climate Bonds Initiative. And all of that is done under the ISEA 3000 standard, so we use that kind of established standard to ensure that there is vigor in that reporting process as well. And I think I mentioned it before, but it's probably important to note that as soon as the bond has been receives pre-issuance certification, the issuer can then use the certification mark for their documentation and marketing process when they go out to market. And then secondly, post-issuance certification, the certificate is valid for the term of the bond unless we detect some sort of problem over ongoing eligibility, for example, and then we would look very carefully at that in that circumstance. And the following slide is just a representation of the types of organisations and a number of the actual organisations that are participants in this certification process, and includes a number of our issuers to date, which include a number of banks, financing groups, public institutions, and development banks across a whole range of geographies, and also is some of the logos of our verifiers around the world. So verifiers apply to be approved verifiers, again to the Climate Standards Board, and once they're approved, they are allowed to basically bid for business as verifiers of the Climate Bond Standard. And some of their logos are on this page as well. And again, that includes global players who operate internationally, but also we have some, interestingly, local verifiers now who are specific to, for example, India and China. We've increasingly got coming on board so that we can have market reach around the world. And then very briefly, on our website, we do have a package of documents to provide all the detail behind this, the parent standard, the eligibility criteria sector-wise, and guidance and certification documents for issuers and for verifiers to help them through this process. And then very lastly, I think just to kind of take a moment to reflect on where we are really in the market. What we've seen is a lot of buy-in from issuers and investors, and we are really looking forward, and I think they're looking forward to seeing a broader and more diverse range of bonds and assets under the Green Bond banner out in the marketplace. And we're seeing a nice uptake now in emerging and developing markets who are particularly looking for international investors. So there's great growth potential in those markets, which we are really hoping to support and engage with on an ongoing basis. And then very lastly, just before we open it up for question and answers, I'm just going to hand back to Johnny very quickly.
Thank you very much, Anna. Just a reminder that you can ask a question in the Q&A box in the bottom right-hand corner. We've had a couple already. Let's start with, when do you expect to see the green bond issuance from China? Third quarter, fourth quarter? Justine, do you want to take that one?
Yes. Again, Johnny, was it when do we expect to see green bond issuance from China?
Yeah. Well, when do we expect to see it increasing and growing?
Well, increase. I mean, I would say that China started playing ball seriously at the start of January and is continuing to issue. We will see out of that 50 billion or close to 50 billion that has been signed off by PBOC. It's no telling if that's going to be issued in tranches from now until into the 2017 year, or if it'll be done all this year alone. But what we can say is that they will be a repeat issuer. Now, back in the 2015 year, we started to see China tapping the international market, one of the first being the Agriculture Bank of China, which I believe was about $1 billion US worth on their first green bond. So I mean, when China comes to tap a market and test it, they don't do it small. But there was enough success with a few issuances that tapped the international market from China that built confidence internally. And so, yeah, we expect quite a bit to come out of the region.
Next question, when do you see green bond funds becoming available and popular on a large scale for the average retail investor?
So we've already seen a very small share. In fact, I think World Bank has actually tapped the retail market with some green bonds specifically for them. And we've also seen out of the municipality market out of the U.S., where it's not only being made available for institutional investors, but also retail. In fact, the MTA bond was a perfect example of this. The retail side of their first green bond averaged, the value I think was around $250 US, so quite successful from that perspective. But you know, this very much is more tailored to the institutional market, and we're looking at anywhere from 100 million or more as a minimum that is attracting institutional investor base. And we've got to also remember that we are trying to shift a significant amount of capital over a very short period of time. The debt capital markets alone are roughly at about 100 trillion US dollars of assets under management. So there's no shortage of capital here. It's just a matter of shifting that to the right projects and assets on the ground globally. And so the institutional investor base is the most effective community to do that. But it's not to say that in time, as the market begins, it grows, that we will not start to see this trickling down more commonly to the retail investor.
A question here, approximately when will the agriculture and forestry guidance documents be released?
Anna, would you like to take that? Anna?
Yep, thank you. I was just being unmuted. Sorry about that. Yeah, we are at the very last stages of the development of the sector criteria, so we expect that will be released over the summer.
Yeah, we had a public consultation period, quite a successful one, great feedback. We are working with the technical working group now to address all of those, make that available to the public, and then we will be having board review. This will be in the weeks ahead.
Thanks, Justine. Next question, how much does third-party verification add to the cost of issuing a bond?
Sorry, Johnny, I couldn't hear you very well. Johnny, couldn't hear you very well.
Sorry, there's an issue with the line here. Next question is, how much does third-party verification add to the cost of issuing a bond?
Yeah, there's always quite a bit of questioning around costs. In terms of the process itself, and what we're seeing is that issuers are predominantly, the fee is around the verifier. So whether you're having a second-party opinion, a full third-party review, you are going to be paying for that independent review. And costs range anywhere from $10,000 US to $50,000 US. It all depends on who you go with and what your portfolio looks like, and so on and so forth. So that's regardless whether you're doing a certification or a second-party opinion. What we are trying to do with the standard, and what we have begun to see evidence with, is that with a large pool of verifiers, we try to start making those costs become more competitive and driving down the costs. Having a common language, a common framework that makes it easier for reviews to be done. So definitely with the cost of the review, but also depending on where the issuer's starting point is internally in terms of tracking proceeds, management of proceeds, and so there may be some associated costs in the initial bond issue. However, once these things are set up, then those costs, I would imagine, are quite minimal. The certification has a fee of 1/10 basis point on bond value, close of bond value, so quite minimal, more of a token fee for processing the information. We don't want to see the certification as a barrier to market entry. So it very much relies on the verification fee. And again, like I said, that's becoming quite competitive now. And since the start of this market, where costs were quite high, we've already started to see the effects of driving those costs down. It's also important to note that the certification itself has seen quite a significant level of attention to it in the last year, where we've gone from 3, 4 bonds certified to now over 20 bonds with more in the pipeline to come. So we're definitely starting to see issuers taking an advantage to going down the certification route.
You mentioned that the bond could lose its certification if during its life it loses its green objective. How will you control this, and who will pay for this certification maintenance?
Well, first of all, that's the beauty of what the certification is offering. Okay, we are offering a monitoring framework, right? Again, CBI acting as a secretariat, governance structure headed by the board, along with all of the committees behind it. And so when a bond is being certified, the CBI secretariat is the ensuring that the issuer is fulfilling its commitments to what the standard is requiring. So if there's an annual reporting on the bond during the bond term, we are expecting to receive that report every year. And of course, we review the report, and if we see that there's anything in there that needs to be checked, then we have the right to bring the verifier back in to check. If a issuer is in default of the environmental credentials, or there's an issue with them being able to fill their commitment or promise, then we work with the issuer to find out, what is the problem, what's caused, is this something that we can resolve? Let's say worst case scenario, which we haven't had yet, but let's say whatever efforts are made, we can't resolve the default, then this is simply removing the certification. So it's a reputational damage, but there's not a financial penalty for falling out of compliance. But it's important to note that that is the difference, because what we don't have currently in the market outside of the certification or under an international standard framework is the monitoring side of this. Okay, an issuer in the pre-issuance phase comes to market with their second-party opinion, and then that's it. Who's checking that? Who's coming back to make sure that that annual report is actually being submitted every year, and who's making sure that that is, of course, the investors, I would expect, would be looking for this themselves, but not every investor has the capacity to do that. So that is one of the advantages to the governance structure of the certification scheme.
Just time for a couple more. What are the main differences between version 1 and 2 of the Climate Bond Standard?
Very good question. Version 1 was very much a prototype in the early days of market development. It was basically the first version of the standard. It covered all the essentials that a bond needed. It still had their general requirements, and it had sector-specific and bond type. But what we've done now with version 2 is make things a lot more clear. The language is a lot more clear. We pulled together an assurance working group, which consisted of groups like PwC, KPMG, Deloitte, all the big four, along with our other verifier bodies, such as OCM, Sustainalytics, and others. Well, we brought them together to really look at how can we make the document meet the market development since green bonds were growing. How do we embed the green bond principles more effectively and make that quite clear that those have been captured? And how do we build an assurance, a proper assurance model behind that? What we mean is a standard that the Big Four can actually provide auditing services against. And so that, I would say, is pretty much the key part of the difference between the first and the second.
Final question then. Is certification ever tendered out from via CBI, Climate Bonds Initiative, or is it always directly with the issuer?
Sorry, Johnny, I don't know if I got that. Say that again?
Is certification ever tendered out from via Climate Bonds Initiative, or is it always directly with the issuer?
With the issuer.
Great, that's all we've got time for. Just a reminder that this session was recorded. I'll send out links to all those who've registered in the next couple of days. To keep up to date with all things climate bonds, including future webinars and our market analysis, you can sign up to our blog on our website, climatebonds.net. Thanks for tuning in, and have a good day.